Hey Daniel, nice to see you again.
Hey, hi Lance. Nice to see you again. Thank you everyone for joining us today. Today we have Lance telling us about a safe note. And as a founder myself, I also have tried to pursue a safe note before because I see that it has a lot of advantages over a price round. Maybe Lance, can you share with us what are some of the issues if a price round is overvaluated or undervaluated, and why a safe note can help to potentially prevent those issues?
Sure. So when we talk about price rounds, right? I what we usually mean by this is a round when equity is being issued for
Mm-hmm.
directly to the investors. Right. So in a price round, what
Mm-hmm.
happens is you have a valuation,
Mm-hmm.
right? We have a valuation. This valuation could be,
Or or a lot of times, angel or an investor just say, okay, for X amount, I want 30%, I
yeah,
want 50%. So
yeah,
essentially, if they are investing 100,000, 50%, they are trying to tell you your valuation is only worth
yeah,
200,000.
right. So it's always X dollars for 1%, right?
Yes.
Whatever that the X and Y can be. Now, in the case of valuations, you have three main
Mm-hmm.
scenarios.
Mm-hmm.
Scenario number one, which is your ideal scenario, is
Mm-hmm.
valuation is fair.
Mm-hmm.
Good for founders, good for
Yes.
investors.
Every
Great.
every founder want that.
And every investor wants that as well, right?
Mm.
In the second scenario is when the company gets undervalued.
Mm-hmm.
And when the company is undervalued, too much shares
Mm-hmm.
issued to investor.
Mm-hmm.
So what that would lead to is in your next financing round, because don't forget this is a
Mm-hmm.
marathon, you require multiple
Mm-hmm.
rounds of financing. So your next
Yes.
financing round,
Because no matter
it
how good a product is, speak to the market, you need extra money to, do more
mhm,
things.
yeah. So the perceived what is perceived by the other investors, the new investor is saying, hey,
Mm-hmm.
does the founder have enough skin in the game? Right? Because now, let's say the founder is only left with 15%, and the
And
investor
he
will
works
look
so hard and he will
and work
just
so hard. Will he actually burn out and say, you know what? I'm not gonna work on this anymore? And then what will happen? So if that's the
just
situation, I'd rather
walk
not do it
away and
or
everybody
walk
lose.
away, right? Walk away, everyone loses. So I'd rather not put my capital at risk, right?
Yes.
So in that sense, it's bad for the founders. It's also bad for the existing investors, doesn't it? Isn't it? Because now
True.
the company has less
True.
money to grow, your valuations go down, you have a headache. So
True.
it's sending a signal. The third case is when the company is overvalued, right? When your company is overvalued, and what happens in the case of overvaluation? The founder is pressured to meet valuation expectations.
For
So if you
example, he overvalue, he think this round he's valued at 10 million. The next round he's supposed to raise at least maybe a 50 million, and he will have a very hard time
convincing the next round investors,
convincing.
right? So what that also means is if you think about the markets, right?
Mm-hmm.
Most of the time startups raise as a multiple of revenue. So let's say today you have 500,000 in revenue. Let's just say your valuation will be 5 million. Typical.
Mm-hmm.
You value yourself at 10 million today when you only have 500,000 revenue.
Mm-hmm.
People could potentially buy. buy in at that price, but in your next round, you want to support that valuation into, let's say, 50 million. What that means is you need to grow your revenues 20x within 18 months. So you are under a lot of pressure. And most people don't make very good decisions under pressure, unfortunately.
And that also affects existing investor as well. So it's a lose-lose situation to either overvalue or undervalue a company. So that sounds like a lot of problem to do a price round, especially where the valuation is uncertain, where a company is young, it's very difficult to price it, to factor in all the upside. Then, in your opinion, why do you think a safe note can prevent all this issue? What is a safe note?
So when we talk about safe notes, right? Safe note is a form. So what safe means is actually simple agreements for
future equity.
For future equity. What it's saying is, I'll fund you now.
We talk about equity later in the future.
You issue me shares in future, right? Essentially, what happens here is you're deferring valuation discussions to the next round.
In the future, where there is a lot more data to justify to
so when we talk
evaluating the company.
So when we talk about this situation, and on top of that, because as angels, most of the time, you're doing this alone, right? You're writing this kind of checks alone. In a case where you have an institutional investor like a VC, I think for those who don't know what these terms are, please look at our previous episode, right? On the various types of the startup investor universe, right? So when you talk about a VC, most of them, they have analysts, associates, who crunch the numbers and say, okay, because of these assumptions and because of these kind of numbers that we are looking at, we are pretty certain that the company would be fair if we value, it will be fair for us to value this company around this range. Right? So that's when they do a price round and say, okay, we are quite certain about this. But as an angel, most of the time, unless you have a lot of experience with like financial modeling and all that, you typically don't have that kind of sense about, hey, this is the kind of valuations we are talking about that we think can potentially work. Right? We don't overvalue, we don't undervalue it. Right? So in that way, it solves the whole valuation issues. So it allows so therefore it allows founders to raise quickly.
And not to mention that the agreement by itself is generally much simpler as well.
Therefore, that also means lower legal cost for both the founders and the investors to go through these documents, because they're pretty standard, right? If you want to take a look at a safe note agreement, how it looks like, feel free to go to YC. YC has a very good
Y Combinator.
ycombinator.com has a very comprehensive guide on that, right? So feel free to take a look at those.
And just to share a little bit to our audience, Y Combinator is one of the world's premier incubator. Instagram, Dropbox, DoorDash, all these companies came out from the incubator.
So,
and I understand Safe Note, there's a couple of versions. Would you like to share with the audience? So you shared the rationale is not to force a valuation when there's incomplete data, and which will hurt both the investor and the founder and the startup in the long run. So I understand there are four different versions of the safe note.
Yes.
Can you share with us which are the four versions and what is the difference between them?
All right. So what I would do is I would draw a quadrant on my screen to
Okay.
discuss this, right? So the
Okay.
first
So we have the
type,
first one.
which is a case where there is only a valuation cap.
Mm-hmm.
The second type has only a discount.
Mm-hmm.
Don't ask me. You see why I'm doing the way the writing it in the way that I'm writing it now. The,
Shortly, yes.
in a very short while. The third version is
Mm-hmm.
when you have both the valuation cap and the discount. So think of
Mm-hmm.
it as a combination of the two. And the
Mm-hmm.
last one, as you can probably guess, it's
Mm-hmm.
a no cap, no discount note. Essentially, what it's saying is whatever the next round is, I would be investing at that kind of terms, the same set of terms. So
Mm.
pretty
And which is
straightforward,
almost unheard of. Yeah.
but
Can you share a little bit
almost unheard
about
of,
how that is?
right? So I will not cover this because it's almost completely
Mm-hmm.
unheard of in Southeast Asia,
Mm.
right? So most of the time in Southeast Asian
Mm-hmm.
context, most
Mm-hmm.
of the safe notes that we see tend to fall in
Mm-hmm.
this category where you have
Mm.
both a valuation cap and a discount.
Maybe
Um,
you would like to share with our audience what does the discount means first and
sure. So I think what we will do is I'll break it down into three sections for this. The first section
mm-hmm.
is when we talk about discount. The second
Mm-hmm.
section is when we talk about valuation cap only note.
Mm-hmm.
And then
Mm-hmm.
we take the two concepts together and we talk about what's
Mm-hmm.
commonly seen here, which is a valuation cap
Sounds
and this
great.
combined with a discount. So in the case of a
Okay.
discount, what we are saying,
Mm-hmm.
I will use some numbers to illustrate this, right?
Mm-hmm.
So in a case where I'm saying this note entitles me
Mm-hmm.
to a 20% discount
Mm-hmm.
off the next round,
Mm-hmm.
right? Equity financing,
Mm.
right?
Because
So
there's no valuation right now, we defer it to the next round.
correct. So what happens in this case is let's
Mm-hmm.
just say, right,
Mm-hmm.
in your equity financing round,
Mm-hmm.
the VC says,
Mm-hmm. Mm-hmm.
the VC says,
Mm-hmm.
I will invest at a 10 million valuation.
Mm.
Okay, 10 million valuation. So for you as an investor, so this is scenario one.
Mm-hmm.
As an investor, you would invest at a 20% discount, which means you invest at 8 million valuation.
And the rationale, I believe, for this is because it's only fair to the first group of investor because they came in earlier and therefore
Yes.
they should have some reward
Some
over the second
upside
round.
to the
Mm,
last round, right? So this is exactly
mm,
correct. So we compensate them
mm,
for time, right? Because there's
mm,
this concept called time value of money, right? For those who do
mm,
discounted cash flow, you know what I'm talking about. So the next thing is you have a second scenario, right?
mm,
In your equity financing, the
mm,
VC says, I don't think your company is worth 10 million. I
mm.
think it is worth
But
5
maybe only
million,
five.
right?
Mm,
So in this case,
mm,
as a safe note investor,
mm,
you would be buying in at
mm,
20% discount again, which means this is a
mm,
4 million valuation.
And I also believe that it also better align the interest between the founder and the first growth investor, because the founder will
Mhm.
not want his company to be undervalued. He will therefore
Yes.
want to be pushing for a higher valuation. Of course,
Mm-hmm.
not overly high valuation.
Mm-hmm.
And so in this case, their interests are aligned, and the
Indeed.
founder will push for the same thing for the first group of safe investor.
Mm-hmm. And then in the third scenario, let's just
Mm-hmm.
say that you so happen to do very well, and the VC says in your
Mm-hmm.
equity financing, your VC says
Mm-hmm.
when let's say 50 million valuation.
Mm.
Congratulations. I'm happy for you that you hit that valuation. So as a safe investor, safe note investor, I will be
Mhm,
going in at 20% discount. So that's a 40
mhm,
million valuation.
mm. Which I understand to a certain degree, it is actually good news for everybody. The company is growing, is worth that
Mhm.
much. But if someone had invest a lower amount, say a million,
Yeah.
and that at a 40 million valuation, it will
Mhm.
translate into a minuscule equity stake, and that is where the valuation cap comes in.
Yeah. So I think let's not jump directly into the valuation cap plus discount model
Okay,
yet, right?
okay.
So now let's go into a case where the next case is when we have purely
Mm-hmm,
a valuation cap.
mm-hmm,
And for ease of illustration,
mm-hmm,
right, I will use a valuation cap of 8 million,
mm-hmm,
right? So I'll use the same three scenarios, right? In
mm-hmm,
terms of equity financing. First case, equity financing,
mm-hmm.
the VC says 10 million
Mm-hmm.
valuation, right?
Mm-hmm.
What does a cap mean? A cap means
Mm-hmm.
that's the maximum valuation I will enter at,
Mm.
right? So for me, as a safe note investor, my maximum
Mm-hmm.
valuation that I will enter at is at 8
Mm-hmm.
million,
Mm.
right? Because that's what I'm willing to pay. I already
Mm-hmm.
tell you that's the kind of pricing I'm willing to pay. I'm not too
Mm-hmm.
sure. I want to defer it to the next round. Now, the
Mm-hmm.
second situation is when the equity financing round says, you know what, I doubt your company is worth 10 million. I only want to invest in your company at a 5 million valuation.
Mm-hmm.
What that also means is for this safe note investor, you would
Mm-hmm.
enter at 5 million valuation,
Mm.
right?
Because
So
you take
now
whichever is lower.
you take the lower price because now it has not hit
Mm.
the valuation cap. I take a lower
Mm.
price. So
Mm. And 50 million will be similar to one.
right. So if, like you said, if you have a
Mm-hmm.
situation where it's a 50 million valuation,
Mm-hmm.
in a safe note case,
Mm-hmm.
right, it's at 8 million valuation. Because again,
Mm-hmm.
I'm only willing to pay 8 million for
Mm.
whatever, right? So I gain my upside, right? For one and three,
Mm.
I enter at the same
Mm.
price in the case of two. Same price
Mm.
as the equity financing guys.
Mm.
Now, the next part is going to get a little bit confusing because we are going to
Mm-hmm.
take these two concepts
Mm-hmm.
and we're going to put them together,
Okay.
right? We'll put them together. I'll combine the set of terms, right? So
Mm-hmm.
now I'm saying 8 million cap,
Mm-hmm.
meaning 8 million valuation cap,
Mm-hmm.
plus a 20% discount.
Mm.
take a look at our number, take a close look at the numbers, and you'll see something interesting. Case number one. Again, equity financing. The VC says, I will invest at 10 million valuation. If I were to go in at the valuation cap, what would be my valuation? Right? I would go in at 8 million, right? If I take a 20% discount of 10 million valuation, what do I get? I also get 8 million, isn't it? Right? So I will enter, right? There's a term that I will be using for this, but I will coin it later, right? But in this case, as a safe note investor, I will enter at an 8 million valuation. There's a reason why I use these numbers. In the second scenario, equity financing says 5 million valuation. If I only have cap, I would go in at 5 million, isn't it?
Yes.
If I only have a discount, what valuation would I be going in at?
4 million.
I'll be going in at 4 million, which is lower. Right? So whichever is lower, because when we have this kind of situations, we always say whichever is lower. So in this case, as a safe note holder, I would actually go in at a 4 million valuation.
So it's the valuation cap or the valuation, whichever is lower?
The valuation cap or the discount, whichever is lower. Right? In the case of only a cap, it's the valuation or the valuation cap, whichever is lower. Right? So now, in scenario number 3, right, the equity financing says I will enter at 50 million valuation. Right? Again, I have 8 million cap. I'm willing to pay up to 8 million. But there's a 20% discount off the 50 million. That's 40 million. 8 million is lower.
So you take 8 or 40, whichever is lower.
Yes.
So in this case, you take 8.
Yes. So in this case, as a safe note holder, I will take 8 million valuation. By the way, Daniel, just curious, do you see an interesting trend?
It tend to break even at 8 million or converge to 8 million.
So what happened was the numbers were essentially extracted from the previous 2 whiteboards, isn't it? If you think about it, right? When we talk about 10 million valuation.
I think so.
Right? So if you let's review our whiteboards, right? In the case where there's only a 20% discount, let me do a quick highlight. Right? Number 1, number 3. Right? Number 1 only. Right? Number 1, if you look at this, there's a number 1. In the next whiteboard, if you look at number 3, right? You look at the case of number 1, and you look at for the previous whiteboard, you take a look at number 1 and number 2, and then for this other whiteboard, when we only have a valuation cap, we take a look at number 1 and number 3. What do you notice? When I combine these 2 whiteboards, I get this. I get this whiteboard.
Okay, because it's discount plus cap.
Yes. So the numbers are, you can see that it's the lower of the 2 numbers from the previous two whiteboards.
Okay, so that
Right?
means the safe investor has the best of both worlds, whichever is lower.
Yeah. For this
Mm.
particular case, when there's both a discount and a
Mhm,
valuation cap. Now,
mhm,
here is where I'm going to coin a term, right?
mhm,
If you look at number one's case number one,
mhm, mhm,
both the discount and the cap yield the same number, right?
mhm,
So this 10 million in this case, right? The
mhm,
is basically the equity financing valuation that will hit
mhm,
a point when the cap and the discount yield the same number. This is what I
mhm,
usually call the break-even
mhm,
valuation. Because no matter which way I go, I get the same
mhm,
number.
mhm,
Which means if you are able to hit that number,
mhm,
you're pretty good at actually doing some financial analysis, doing some valuations, and maybe,
mhm,
or you could be luck, right? But if you
mm,
consistently hit that number, which you are pretty
mhm,
good at hitting fair values of companies,
mm.
right? So this is
So because what the cap that they ask for is turns out to be almost what the next round investor is asking for.
yes, yes. So this is how it, assuming that there is no change in your numbers and all that, that's about the
Mm,
same kind of valuations that the other
mm.
investors are looking for, which means you are pretty good at hitting that sweet spot.
Okay. So would you say for most average angel, they shouldn't go for valuation cap then? Because they may end up having a too low a valuation cap.
For most angels, what I recommend
Mm-hmm.
is I would go for, as an angel investor, I would go for a cap with discount note because I have the
Okay.
best of both worlds. But as a founder,
Okay.
you need to consider what happens in future, right? Are you sure you are
Mm,
able to hit beyond that break-even valuation that your angels are implicitly giving to you, right? So in this case,
okay.
are you certain you are able to hit a 10 million valuation in this particular case?
Okay.
Yeah. So
Got
that's
you.
the question that founders need to ask themselves when they raise a safe note.
Got you. So in other words, the valuation, while there is no valuation, the valuation cap is does give them some consideration.
Mhm. Right? So it does give you some consideration, right? So when let's say I
Mm-hmm.
tell you, okay, 8 million cap with 20% discount, what I'm thinking
Mm-hmm.
is I think your
Mm,
company will be worth at the bare minimum 10 million in your next round.
mm,
So my question is, are you able to
okay.
hit that kind of are you able to hit the traction
Mm,
that would yield that kind of numbers for the for your next
mm.
investor to say, I think this company is worth at least 10 million?
Got you. Got you.
Because
Got you.
otherwise, when the discount
And
hits,
mhm,
it can be quite hard. As you can see, when the discount hits, it can be
mm,
quite hard.
okay. And to end of today's session, I believe you also have prepared a calculator
Mhm.
for both interest and VC to use.
Yes.
Maybe you can explain a little bit how it works, how to
Sure.
use it, and we will be posting the link to it.
Mhm. Sounds good. So what I will do is let me switch the screen to my little calculator. 1 minute, please. Okay, loading. Great. So
Yes.
you can see the calculator in front of you. So what we ask
Mm-hmm.
for is when you input the highlighted fields,
Mm-hmm.
right? So this is a case
Mm-hmm.
where, so I usually start by inputting the valuation cap and the discount. So let me
Mm-hmm.
use the, so when we say
Earlier example of 8
earlier
million.
example, right? 8 million
Mhm.
and a 20% discount,
Mhm.
right? So you realize that the quote unquote break even valuation is about 10,
Mm.
right? Which was what we discussed earlier, how we derived those numbers earlier. So let's
Mhm.
just say you in you invested 1 million,
Mhm.
right? And that's you are the only investor in that round,
Mhm.
right? So in the case of a pre-money valuation of,
Mhm.
let's say, let's use the
Mhm.
same number, 8 million,
Mhm.
right?
Mhm.
Let's say 10 million,
Mhm.
right? You convert at 8 million,
Mhm.
right? Which is our break even. It is you
Mhm.
realize that the numbers would come up to the same, and then it tells you approximately what's the percentage of shares that you get from this safe note.
Mhm.
In scenario number 2, when the round happens at a pre-money
5 million.
5 million valuation, you get about
Mhm.
20%, right?
Mhm.
Now, in the third scenario, when the valuation is 50 million,
Mhm.
you realize that you still go in at 8 million, right? So you still get
Yes,
about,
because there's a cap.
yes, that's the cap. So you realize that it's a slope upwards, and then there will be a plateau
Mhm.
off at 8. So this is how
Mm.
the calculator can be used. Feel free
Mhm.
to feel free to use it, right? We'll be posting the link to
Mhm.
this calculator for everyone to leverage on, right? And with that, we've come to the end of our session today, right? Thank you very much.
And the next round, we will be talking about the role of an angel. I think angel are very, very important in the startup ecosystem. They add a lot of value. It's not just about funding. They provide things like connections. They provide valuable know-how. So we have prepared a guest that will be joining us in the next session. So
Mhm.
please,
Feel free.
everyone, stay
We
tuned
look
to,
forward to seeing you guys next week together with our guest, right? So that
yes.
our guest would share their insights with you, right? With that,
Thank you, everyone.
take care, stay safe. We'll see you next session.